All right. So today, backdoor Roth contributions. So many people have heard of this. I get asked about it maybe, half a dozen times throughout the year. So let's talk about what this is. So this is when you cannot make a contribution because you earn too much money. So I'll share here. Let me pull down the Backdoor Wealth Management website. There are these charts that are available to everyone. You go to the home page and then over to the slot corner here. And as you scroll down from the top of the slot corner, where we have all that great information about Ed. And I'm going to see Ed in October. We have to go out to Las Vegas. Well, it sounds exciting, but I don't want to go to Vegas for our training. But you can scroll down here and you can see these are the 2022 retirement plan contribution limits. So there are contribution limits for IRAs and back down here for Roth IRAs. So we're not talking about 401ks right now. We're talking about IRAs. These are what you can contribute in IRA or Roth IRA. So you can see for 2022, it's $6,000 until you're over 50 years old, or you reach 50 years old, I should say. And then you can contribute another $1,000. So that's $7,000. So now if you're working and you earn at least that much, you can contribute into a Roth IRA. And if you're married, and even if your spouse doesn't work, then you can contribute another $6,000 or $7,000, depending on your spouse's age, into a Roth IRA. Except the IRS says, unless you make too much money. So what's too much money? So we have these Roth IRA phase out limits. In 2022, the phase outs start at $2,000 and $4,000 of modified adjusted gross income. I think that's modified. It might be AGI, but it really doesn't matter. I think it is modified adjusted gross income. $2,000 and $4,000, $2,204,000 to $214,000 is the phase out for married and the filing joint, and $129,000 to $144,000 is the phase out for a single or head of household. So what does phase out mean? Well, they're simply a percentage that you can contribute of that $6,000 or $7,000 while you're in this range. And then after you're over $214,000, you can't contribute anything into a Roth IRA. Same for single or head of household. So what do you do? Many people say, okay, well, geez, I can't contribute. But then they read about these backdoor Roth contributions. And a backdoor Roth contribution is simply contributing money into a traditional IRA. And let me go back to this deductibility levels. Here is the phase out ranges for IRA. Now, traditional IRA deductibility. So they're saying you can't put money into a Roth IRA. The IRS doesn't say that you can't put money into a traditional IRA. You just can't deduct the amount that you put in. So they'll allow you to put $6,000 or $7,000 into a traditional IRA, even if you earn more than $129,000 for a married filing joint couple, your modified adjusted gross income, or $68,000, $78,000 if you're single or head of household. So let's go to the married column. Your adjusted gross income or modified adjusted gross income is $129,001. You can no longer contribute or take a deduction for your traditional IRA, but you can put the money into the IRA still. So now you have after-tax money in your IRA. So but let's say you're actually $215,000 and you can't contribute to the Roth. You can't take a deduction for your IRA contribution, but as you saw, the IRS still allows you to put money into the traditional IRA. Well, currently under current legislation, you can move that money right to a Roth IRA via conversion. So don't forget, we're talking about, I'm going to move this down so I can write on it. We're talking about contribution versus conversion. So we're talking about contribution here. Let's just assume we're all over 50 and we're using that $7,000 number. So that's the amount that you can contribute into an IRA or a traditional IRA or a Roth IRA, but you've got to pay attention to the income limits. a conversion, we know that you can do as much or as little, right? You can do $1,000 and or less. You can contribute as little, right? I guess you could do $1. So let's just say to 1 million or plus. So there's no minimum, there's no maximum that you can do a conversion. And there's no income limitations. There's just none. The conversion method is the best gift that the IRS and the federal government has ever given us, because there's no restrictions right now. There used to be, but they lifted them. So again, you could do as little or as much as you like. And it's a gift. Contributions are very tightly regulated. So what you do is with the backdoor, here's your traditional IRA. And here's your Roth IRA. You put the $7,000 into here, or $6,000 if you're under 50. And then using the backdoor method, you immediately, so that's a contribution. Don't get a deduction. You can't get a deduction. You make too much money. You can't get a deduction. And then you immediately convert that money to the Roth IRA. So contribution, conversion. So now the $7,000 sits in the Roth IRA. Ideally, you don't get a deduction for this $7,000. This comes out of your savings, cash, stocks, whatever. So you don't get a deduction. You move it right over. Now you don't pay any tax on that conversion, because this is after tax money. I hope that makes sense so far. So that sounds really simple, doesn't it? Yeah. Except for there is a thing called the pro rata rule. So the pro rata rule is where most people get stuck with this, and why it doesn't work for many people. So let me see where we are. Make sure I'm all right. We talked about this. So let me just stay with this. So the pro rata rule, this sounds really simple and easy, $7,000. Hey, and I could do that. If I have a spouse, I could do it times 2. Now I've moved $14,000 into this. I don't know what happened there. Let's close that. No, I don't want to hit reload because I'm afraid we're going to, it's just click, raise your hand for me if you're seeing my whiteboard. Okay. Okay. Thank you, everybody. So the pro rata rule simply says, well, this all sounds great, but the problem is if you have money already in your traditional IRA, you can't, well, you can convert $7,000 into this, but the IRS is going to calculate what the percentage is of this $7,000 to what your balance is in your IRA. And that's the only amount that you're going to have to, or that you're going to be able to convert tax-free. So let me break this down and tell you what I mean by that. Let's just say, let's carry these buckets down. So this is traditional IRA. And this is Roth IRA. Now, if you have no money in your traditional IRA, this can work well, right? You deposit $7,000, you immediately convert it over, and there's no tax due. But now let's say we have $100,000 to make the math simple in a traditional IRA. Now you've read about this backdoor Roth conversion, or yeah, Roth contribution, excuse me, and you make a $7,000 after tax contribution into your IRA, because you can do that. And you say, I read how this works. I'm going to now immediately convert $7,000 over to this Roth IRA, and I won't have to pay any tax on that because it's after tax money. And then you go through your year and you've done this tricky backdoor Roth conversion, and now it's time to do your taxes, and your CPA either tells you, oops, something happened, or worse, you go through a few years of doing this and the IRS comes back to you and says, you owe us some tax money. Because the pro rata rule says, well, if you're converting $7,000, we're not going to let you just identify this $7,000 as conversion. We look at the entire thing, and very simply, we'll take that $7,000, we'll divide it by the $100,000. So that is clearly 7%, and only 7% of this $7,000 that you've converted is entitled to be converted without additional tax. So that is $7,000 times 7% is $490. So $490 of this transfers over. You don't pay tax on it. But the remaining, what is that? $6,510, you owe tax on the conversion. Now, what's left then is you now owe, this is good. You transfer that over. Now this is still here. And if you decide to keep it there, you're going to owe tax on $6,510. And then you've got after-tax money here in your traditional IRA that you're going to have to keep track of. So if you want to do a series of conversions, you're going to have to keep track of how much of it is taxable and how much of it is tax-free. So it's a bit of a paperwork nightmare. There's forms you have to file, of course, forms 8606 when you do this, and you should be filing these when you do the Roth conversions to help keep track. But what happens is that most people don't, and you end up paying tax on that money twice. So it's pay attention to the pro rata rule and what the effect is. This is if you have money in a traditional IRA. If you don't have any money already in a traditional IRA, then it can all work well. So it's when you make too much money to be able to contribute to a Roth IRA, you can contribute a non-deductible traditional IRA and immediately convert it. But you have to pay attention to the pro rata rule. This jams people up all the time. And then you have to, well, you can't recharacterize a conversion anymore. So you're stuck with it and you have to deal with the repercussions of it. So I have a question here. Let's see. Bill, can I put the $7,000 with a different bank to avoid the pro rata, i.e. have $100,000 in Vanguard, but put the $7,000 in Fidelity? Great question. I appreciate you saying that. No, the IRS looks at the aggregate. It doesn't matter. So what Bill's asking is, what if I have two or more traditional IRAs, right? So traditional IRA 1 and traditional IRA 2. What if I have, two of those, or some people have several? Can I kind of game this in the IRS? This one has the 100,000 in it. This one has 0. I'll just fund this one at $7,000 and convert that to a Roth. And I win, right? I won't have to pay zero. You won't have to pay tax on that. Now the IRS gets that, and they get reporting from each one of your custodians every year of how much money you have in traditional IRAs. So they know that trick, Bill. And even if you got away with it for a year or two, you're going to get snagged on it because you're going to see what this is. So the requirement is on you, of course, to properly calculate this, and the pro rata rule is very, very clear. You have to aggregate all IRAs. So good question. Now, one thing you could do is Ed Slott refers to this as a reverse rollover. So say if you have $100,000 in an IRA, right, a traditional IRA, and you want to do this backdoor Roth conversion, and you have also a 401k that accepts rollovers from IRAs, well, you could roll that money into your 401k. Now that money sits here in your 401k, your traditional IRA has $0 in it, not percent dollars. That does not count towards a pro rata rule. There's a wall there. So for the IRS, it does not count for the pro rata rule. So that's one way you can get around it. For most people, it's not that meaningful, right? $7,000 a year, $14,000 a year. But if you can do it, you can. What I don't have time to get into, and we could talk about another time, is the mega backdoor Roth, and that is that refers to retirement plans. So I believe this year it's up to $58,000 or $53,000 a year if you're allowed to do after-tax contributions to your 401k. So this is after you've maxed out your 401k earnings, and let's just say you don't have a Roth option, or maybe you do and you just want to put more money in there. You can do after-tax contributions to a 401k if your company allows you for non-hardship in-service withdrawals, which simply means that you're over 59 and a half and you can take distributions from your retirement plan without any kind of penalties or anything like that. The IRS says you can. Some companies are more restrictive, but you could then roll that to an IRA, convert the entire thing to a Roth IRA. Of course, you still have the pro rata rule requirements, but that can really move the needle for you when you can get that much money moved in. Great question, Bill. Thank you. The last part I have on here is pending legislation. Yes, there is pending legislation to eliminate the backdoor Roth IRA, which is really surprising to me. The IRS has said it's a fine process. Over many years, they've said that they acknowledge it and they say it's legitimate. You could do this. But I think it was the Build Back Better plan that obviously didn't make it through all the way, but they wanted to eliminate the backdoor Roth IRA, which again surprises me because you've got to pay tax on the contribution. But I guess as I'm thinking through it, it's allowing more money to go into tax-free and build tax-free without any immediate tax benefit if done right to the federal government. So I guess it does make sense. All right, folks, that is it for today. It's 10:49. It was good seeing you all. We'll see you next week. If you have any questions, reach out to us. If there's any comments or contributions you want to make, I'm always open to it. And we'll see you next week's webinar and the special webinars coming up. Take care. Have a great week. Bye.